Alicia, the floor is yours.
Yes. Okay, so welcome everyone to today's session. A few housekeeping items before we get started. So if you have any questions that you would like to ask the author, please use the raise your hand function or type your question in the chat box, and I will call each person in the order that you raise the question. And also, if you could mute yourself, that would be great so that we can have less background noises. But if you could turn on your camera, we would greatly appreciate that as that would be more engaging for the presenter. So today we have Agnes Cheng from Oklahoma University telling us about the omission of mandated segment line items on stock price update. So Agnes, the floor is yours, and the first 5 minutes is uninterrupted.
Okay, great. Thank you so much. Can you hear me? Can you all hear me, right? If you cannot, Alicia will help you. Okay, as you can see the screen that I'm looking at the mandated segment line item disclosure and how does that affect the stock price, okay? And so first, that I actually wanted to overview of our paper in 5 minutes. And what we are looking is that, for the requirement for the segment disclosure, that is SFAS 131. Couple decades ago, they mandate the disclosure of financial line items that top management, but the requirements that let's use a management approach because it's costly to prepare the information. If managers have already looking into those line items for the segments, and why not report it? Okay, and another rationale is that beside the cost is that if managers think about those line items are very important, and then, probably shareholders would then focus on those line items. So this idea, is good. And however, I think whoever followed the FSB segment, there's a lot of changes and modification and new requirement. And so what we are going to do is provide empirical evidence to see that omissions of or disclosures or lack of disclosures of mandated segment line items under this 131's management approach, how does that affect the market? Okay, and we call the stock price update delay because our main analysis is using a methodology used by a finance paper. Okay, however, we do many different analysis like ERC or PEAT, the earnings shift, that we like accountant research kind of familiar with. Okay, and so our main finding is that if companies emit more, they will lead to price inefficiency. Okay, and so we first document that historically what happened. And we found that multi-segment firms emit about 50% of the time. Okay. And 50%, does it sound bad? I don't know, because of maybe out of the total mandatory items that many companies, they do not look at all of them, okay? And also that we find that multi-segment firms with more line items omission, they actually are not good for the price efficiency. They have greater delays in price updates with their single segment peers. Okay, and again, as I said, the price delay, we are following the industry focus on industry news that like how does the current return forecast future return. If the current return continue forecast future return, that means there are information out there that stock market has to take time to digest. And of course, I will talk about that methodology a little later. Then we also do the cross-sectional test because of if the management approach is effective, and then we should not see the price update delay. But we do see that. So we wanted to look at subsample analysis to see what kind of reason may drive the inefficiency of this management approach. So we look at managerial ability. If manager, they have a very good ability, they should be able to focus on or look at a segment of financial line items that is effective for them to make decision and then report it. And then we also look at a strong corporate governance that because you all know disclosure or less disclosure, usually one of reason is to due to the agency cost. So we look at cross-sectional test, we look at corporate governance also. And also that the disclosure, if the companies are facing high competition, they will tend to hide some of the disclosures. So basically, we try to see that for the superior managerial ability, strong corporate governance, low competitive harm concern, that do the price inefficiency still exist. And we actually found out price inefficiency does not exist, but mainly for when we say strong, we focus on only 10%, okay? And so in that regard, management approach is effective for at least 10% of the companies, but the other 90% could be due to more like other reasons, like agency cost. And also we do a lot of additional tests. For example, if companies is very complicated and then the disclosure matter more, we also look at ASC 280 codification, apply that to a different difference test. Again, we do the ERC concurrent market response and also the delay PED. And we look at how does this omission relate to information and asymmetry, of course, different type of price inefficiency measures. So this is basically, what we do. And but you know that devils are in the details. So let's see what are the details that my study do. Okay.
Agnes, we have 2 questions from Paul.
Okay, wonderful. Hi, Paul. Hi. Okay.
Hi, Agnes. Great to see you. Just a quick question. Maybe you'll get into this, but looking at that slide, are you implying that the manager is basically doing something illegal by withholding information that's mandated? I wasn't quite sure.
No, yeah, and actually not necessarily legal, but they manager will do kind of things like appearing they are legal. That, for example, they will say, well, you will see a couple examples. There was, we don't really look at total assets because total assets is one of the mandate. And they said that our chief operation decision, maker do not look at that. That's why we don't report it. And SEC, of course, follow this and send them comment letters. So the company will respond accordingly. Yeah, so they will find reasons to say why they do not disclose that if they chased after SEC. Yeah, but like sometimes maybe those reasons are not believable and maybe SEC will chase them furthermore, or maybe even have a, lawsuit going on, things like that. But it's kind of rare, to see that kind of negative consequences. Yes, Brett?
Yeah, my question was very related to Paul's. So I was curious how interested you are in discerning between those things. Is the management hiding these things and they're essentially non-compliance? They actually do regularly receive that discrete information at that level? Or is it that they don't? They look at their business more integrated as a whole on the consolidated basis for certain of these line items, right? So you take like interest expense or interest income. Maybe they
Yeah.
don't internally allocate that to the segments, but they keep that at the consolidated level. And so they are being transparent. They're not hiding necessarily how they do it internally.
Yeah, so that's what we look at some anecdotal evidence. Manager will provide like appearing good reasons. So SEC let them go. And
Yeah, so you mentioned the SEC comment letters. Have you considered looking at the comment letters to see which companies the SEC is asking questions about this?
in this study, we do not report comment letters, but we do look at, and potentially we may add that or work out separately. And SEC do, chase after companies, but
The
in
reason
terms
I'm
of the
asking,
percentage, yes.
yeah, the reason I'm asking is as researchers, we cannot observe the internal reporting structure of these companies. All we see is the external, right? What they report.
Yes.
But the SEC can ask, and you'll see that's actually quite frequent. You won't see the internal reporting because it's protected under confidential treatment.
Exactly.
But the SEC staff will often say, we want to compare your internal reporting structure with what you're reporting externally in the segment footnote. And so maybe you could look into the cases where the SEC is at least asking questions to see, does it seem like they're more likely to be really hiding or non-compliant with this versus they just don't receive the information at all?
Yeah, sure. That's a good suggestion. We can look at a little bit smaller sample to see how things goes. Yeah. Okay. I think I see a Wagner.
Hi, Agnes. Thank you.
Hi.
I wanted to double check with you. So is this price inefficiency okay for the firms? Do they do a cost benefit and they live with it because there is some private benefit to the firm for hiding this information? We have the classic hypotheses on proprietary information, etc. So it seems like this is something objectionable, but what does the firm have in it as a benefit?
Yeah. I think that it's also a good question. Managers always had trade-off between the costs and benefits. That, for example, they're dealing with competition and they want to hide some information. And if the rule says you have to reveal that, they'll do something, still try to hide, and they sacrifice the market positive response or market, assessment of their firms. But they may gain a long-term cost. So in terms of the, the trade-offs that managers make a choice that, it could be analyzed. But this is kind of similar to, say, managers, manage their earnings and the market doesn't believe that. And that's the cost. They have reputation concern, all sorts. But if they have protect their other benefits, such competition and things like that, then they will do it. So if we look at ex post analysis and saying that, well, managers do not really care much about market responses, that probably means that they get some benefit from other sources.
The reason why I asked this is we have the analyst literature in which we see that the firms, they remedies the situation when there is a lot of information asymmetry. So for a high type firm, one would expect that they would try to correct any capital market inefficiency. So is this some, like your cross-sectional tests also show that probably they are the low type in which they have managerial problems, agency concerns. So I was just thinking, would you want to do some follow-up tests just to see, is it those type of firms that don't remedy anything in the capital market? Just like they do
so
for
I
the
think in our results is kind of implied that there's some sort of other benefit that we do not really show directly. And for companies that they're high competition, I think we can say that they don't reveal that. They are protecting their competition, power, and which is more positive than, than not reflecting the return. And so and also we're looking at like current return predicting next month, and that's a kind of a shorter term, and the manager may not care too much. But basically finding that, the low disclosure do kind of not provide enough information for the market. Market will demand more information. Yeah, so in terms of cost and benefit analysis, I think that's bigger issue, and it's important issue to look at it. Okay, we are kind of initially document this.
Question from
Okay, Paul. I see Paul.
Yeah,
See,
I'm sorry. The follow up my previous question. So the example you used before, you said total assets, and I just have two questions about that. So when a company omits total assets, something like that, is that going to be a perpetual omission? Like if they omitted it in 2024, they also omitted it in 2023, 2022?
yeah,
And the reason I asked that question is with something like a balance sheet account, they tend
Yeah.
to move slowly over time. So if I had it last year, even if I
Yeah.
don't have it this year, I can kind of guess what it is.
Yeah,
Whereas
yeah.
whereas an income statement item like revenue, something like that, even if I knew it last year, I wouldn't necessarily know it this year.
Yeah.
So is there a tendency to admit, same thing over
Yeah.
time and balance
Yeah.
items versus flow items?
Yeah. So we also look at the persistent, we don't report it here. And case analysis do show that they will persist, but then sometime they will change. They will suddenly report it. Okay.
And
Yeah. And so we kind of I forgot the result, but we look at the persistence of individual items, and we do see some, but it varies among the elements, how persistent they are. But again, this open very good questions, to see what does that mean when they change. Yeah.
And just to follow up on that, when you looked at the quote unquote inefficiency that results,
Yeah.
do you if you divided your omissions into balance sheet items like, as you said, total assets versus income statement
Yes.
items like
Yeah.
revenue or something like that,
Yeah.
do the efficiency effects tend to dominate by one or the other? My intuition would tell me that the if inefficiency effects are going to be greater for income statement items that are omitted as opposed to
Yes.
balance sheet items.
Yeah, you got it. An income statement does provide more inefficiency. In other words, missing those because of like U.S. market is income statement driven, and more than balance sheet. So
Right.
income statement missing is indeed leading to more pricing efficiency, and that kind of agree with the amendment. FASB amend that there are a few cost item, I think they want the companies to provide, and because of those operating expenses, it's very important. Yeah. Okay. All right. Yang?
I have a
Yeah.
question. So
Yeah.
I think the discussion so far sounds like the paper focus on just one dimension of the segment report table, right? So you focus on the line items, right? But there's the other dimension is the number of a segment, right? So for all those arguments about price efficiency or managerial incentive to hide information, I can give you a very, very detailed line items, but I only give you a very core segments, right? The US versus non-US. So like essentially that is almost like you're consolidated your report. There's not much information incremental in this segment report compared to so that's something you consider into your hypothesis or you try to control for. How does that fit into this overall market?
So we focus on firms choosing to provide financial items rather than geographic segments, and we actually see about a majority, like maybe 55, 60%, they choose the detailed functional items. In other words, if they choose to report the operating segment, rather than geographic. And The number of segments, we also do the cross-sectional tests and try to see more segment versus less segment in terms of how details firms do. Yeah, so that will be number of segment will be more as a control variable or a cross-sectional, comparison. Yeah, because more segments, more complicated. More complicated, you will need more detailed information. Yeah. Okay. There's a lot of details that, and actually remind me we may want to report it or footnote it. Yeah. Okay. Thank you so much. Okay. Great. Now let me get to the details. And here is just a quick background that we know the management approach that should be consistent with how management internally organize the firms. And it is first introduced in 1997 and 2009 that, FASB issued the codification and then try to improve the disclosure. And 2016 that FASB feels like the segment reporting line items not sufficient, so try to ask for comments. In 2023, the amendment mandate additional items that significant segment expenses. Okay, and so this is kind of a imply that income statement key items, are important, are needed. So kind of a consistent with. We want to see if it's consistent with our empirical analysis, even though we haven't been able to use data after 2023. And so this is just some fun information and criticize that the details are hidden, even from the large companies. Okay. And so let's look a little bit more detail in terms of the framework. First, company need to determine operating segments. And then the important part is that the regular reviewed by Chief Operating Decision Maker, CODM, that if they are in charge, and then they should report what type of financial information details. And also there are some additional requirements, like if it's significant to the firm as a whole, like 10%, then they have to report the details. And that if companies choose to, they can aggregate similar operating segments into a big one and then report. And then need to disclose specific financial line item for each reportable segment. So this is some kind of details that financial information are mandated, are required to be reported for individual segments, like a measure of profit loss, total assets, or an additional. Okay, specify the component item here. In the rules, there's 12 of that. But in when we use the CompuStat, the count will be a little bit different. And for example, a special item that is not specifically required, but we know that it's kind of, a lot of those are, one-time items, in principle. Okay, so you can see that and company are required to report those some measure of profit loss, total asset, sales, and inter-segment transactions, blah, blah, blah. You can see that. I don't need to go into detail. And so the principle is that they must be disclosed if this item are regularly reviewed by or provided to by the CODM. So this is the restriction. Okay, if other non-CODM review the segment reporting, not CODM, you don't have to report it. Okay, and so total asset information, for example, that if it's not recorded or not used to buy the CODM, they don't have to disclose, but firms have to provide the reason why. So in that case, really the mandatory items to be reported are mainly the segment sales and segment profits. Okay, so as I mentioned, management approach may work because of the items reviewed by the chief operating decision makers that should be most value relevant because they use that to make decision and should be useful for financial statement users. So this approach suggested by 131 and continued modification that we should see, right, price efficiency increase. And also that companies can choose to report voluntarily, and which is a very small number of voluntary disclosure. So this is just kind of summary of the rule. And let's look at an example, like an alphabet segment disclosure. They listed 5 items for Google and Alphabet segment. And that is net sales, operating income, depreciation, special item, and capital expenditure. And they don't report the segment asset because they say its CODM does not use asset data to evaluate segments. And so SEC questioned on the segment financial data review and by the CEO page, okay? And you can also see that the reason Alphabet says that Page, who is the CODM for Alphabet, they review weekly summary of revenue, operating profitability, but not total assets. And the CEO of Google, Peter, have access to more detailed data, but they are not reported in the segment reports. So you can see that they were saying that, okay, the ultimate CEO can look into those, but for this segment, they only look at revenue and profitability. That's why they don't provide the total asset. I don't know, and because they're following the rule, so SEC kind of let it go. But by looking at this, you know, we were wondering if the management approach is real effective. People can kind of only rely on CODM, but there's many other information the manager actually use, which is not reported. Okay, so
Agnes,
that
can I
is,
ask a quick question?
yes.
When you were
Sorry, I
talking,
didn't see your
no,
hand
you're
raised.
fine. You're
Yeah.
just fine. You were talking just before about how multi-segment companies are very difficult for valuation purposes. So I wanted to ask you about your concern, if there is one, of comparing multi-segment companies to single segment companies. I know you do the pseudo controls that you structure those and kind of put those together, but if a single segment company economically is just easier to value, you know, it's more transparent, is that a fair comparison?
Yes, that's what we kind of follow the, you know, finance paper and do the multi-segment and compare with the single. We also do the regression, you know, try to see if the single versus a multi, how do they perform? And then we don't have to use the pseudo, you know, multi. Yeah. So we'd have analyze the typical ERC or PED. Yeah. Okay, Paul, I see your hand raised.
Yeah. So this example you gave with the Google, this is exactly what I was thinking of before. Is that so Larry Page? It's very important for him to know the sales and profits of each division. But as
Yes.
far as assets go, you know, he doesn't need that immediately because he had it last year or last quarter, and it's a slow moving number. So even if they don't report it, he knows pretty close to, you know, accurately exactly what that number is anyway. So this would be a perfect example where I would think this is not intentional withholding. It's just he doesn't need that information.
Yeah. And it could be like not intentional, but so that's why we report, and that's why SEC say it's fine. And however, like relate profit and asset allocated to individual, to me, seems important information. But they're not reporting it because of the management approach does not suggest they have to. Yeah. So this maybe make us to think about, does the management approach really, reach its purpose? Okay. Paul,
So
are
one
you
more,
saying
one more comment, one more. So I don't know if you cited my paper, but I had a paper many years ago in Accounting Review that found
Yeah.
that when firms switched to 131, they had much more future earnings information impounded into returns.
Yeah.
So it
Yeah.
did provide information.
Yeah, I think we did actually. After there's quite a lot of paper looking at the transition, from the previous standard to 131, and then find out 131 does help. Yes. And so, but 131 does help if you think about round regressions 1, 0. But then it helped, does it, really help in terms of the number of items being provided? And somehow we do not see any study provide that. So we kind of see we should kind of provide this, to see what's going on. Yes. Yeah, thank you. And so this is another example that they were also saying that we do not access performance of our segment on other measures, so we do not provide reports. So there's a lot of this kind of reason they all appear good. So so that means if they that other information is not important as they think for the operating decision making, a management approach should be good. And but on the other hand, if management approach or the shareholders would like to have more information beyond what is used by the segmented operating decision maker, and this management approach may not work. So, okay.
I have a question from Lisa.
Yes, Lisa.
Hi, Agnes. A very
Hi.
interesting paper. So my question is another question. Maybe it's more like high-level comment for your paper, because from the example you are showing here, it looks like the company actually are still disclosing, for example, their COD and whether they are truly using this information to allocate resources to that segment or not. So it's not like didn't even say anything. So then it's more like all of this disclosure sounds more like for the regulatory compliance. So basically, the standard saying that as long as you are using this information for the resource allocation, then you disclose such line item. Otherwise, you don't. So then your paper is trying to show that if they omit such a disclosure, then we would see more price inefficiency. So it sounds like a trade-off between truly the market mechanism, what the information demand from the investors, and the regulatory compliance. And then the more surprising thing, and not surprising, interesting thing from your finding is that you actually document this for more than 2 decades, like 20 years, right? From 2000 to 2020. And then when you responded to Paul Navarka, you were saying that a lot of results are pretty consistent over time. And also the omission of the disclosure is pretty consistent. So it shows, it really looks like a lot of these managers, they just ignore the information demand from the investor, the market, how the market mechanism should work. And then they are more only prioritize the regulatory compliance in the end. So I feel like the paper maybe also high level also speak to this kind of discussion.
Yeah, yes. That's so that's what we do not really, list a lot discussion about how efficient management approach is. And we just kind of describe that potentially, and it may not, work because of whatever the COO or CEO they think is important, they report. And but the as I mentioned, the stock market may need that information. And so I don't think our in analysis do this in very detail. and because there's just a lot of empirical results already. But I think that's an important implication to see that what other data are needed that the segment, decision maker do not need. And that will be kind of interesting to see. And so what we find is that actually, only in some extreme cases, the manager approach works beautifully, but not all. So thank you.
Aya has a question.
Yes.
So like, I think related to your previous slide about this CFA Institute survey, I think I kind of like alluded to my earlier points, and also like, I think in January when Christine Bodison actually gave a kind of FASB update about this ASU 2023-07. I think that there are two elements in this survey, right? When participants or users are thinking about whether the number of segments actually are meaningful for their analysis, and then conditional on that meaningful disaggregated breakdown, then how detailed are the individual line items within each segment. And then I think according to Christine, it sounds like the initial proposal has two elements that they are going to require firms to give more disaggregated segments. And on top of that, in the step 3, there will be more detailed line items. But at the end, I feel like there are greater pushbacks regarding the first order effect, which is the number of segments. That's why at the end, they gave up and then only mandate the second components, but still giving managers discretion to kind of like decide how disaggregated number of segments are. So I think kind of going back to your earlier motivation, exposed, that is the new requirement, but I think it's an endogenous results because the first order effect actually receive a greater pushback. So I kind of encourage you to take a look at some of those documents, like basis for conclusion to something potentially that's that reconcile with some of the CFA Institute survey is that some of the users actually want more detail. So think about like FSA class that usually our students want some product line or market specific segments rather than a very coarse segment. And then the second order is, okay, what are the line items are available? And this also related to kind of the earlier point that Brett brought up is that whether multiple firms are actually comparable to a single segment firm. And one way to think about it is that if you can ideally hold constant the complexity of the business, one way to actually find a better benchmark will be firms with similar number or granularity of the segments. And then we are comparing the second order effect, which is how detailed within each segment the information is provided.
So in terms of number of segments right now, we just kind of calculated the reported financial item detail and weigh the segment based on their revenue. And so if we think about that, like one segment should be even more detailed, and then what we're going to think about like how will that affect our measure, and as well as the variability. And as I said that during our sample analysis, we do look at the, high number segment versus low number segment and see how it goes. But I think we can also go detailed to show the discrete statistics and then and see that how the number of segments actually affect our measure. And when you have more, because we weigh it by itself, when the number of segments become more, we may have more variability of our measure. Yeah, but we can look at that. Okay, thank you very much. Okay, so this is the survey evidence, segment level data useful. The survey basically say, yeah, it is useful and it's even like equally important and even more important than the overall details. So that again, some survey evidence that some CFA members would want a company disclose all income statement items, and some feel like they should disclose all balance sheet item. So as I think Paul commented on, and the income statement item you can see have higher demand. And however, difference is only 8%. And then, you know, the survey says total asset is the most important and items. And then, you know, market would like to have that information. And also, they would want to have more information on, say, capital expenditure, depreciation, and goodwill, etc. So this is a survey. And I think the survey also fit into the FASB's decision, like looking at need more disclosure. And so here is some quick literature that previous study, they primarily focus on the general informativeness improvements post-transition from S14 to 131. Okay, so I kind of comment on that. And I'm not quite sure. Did we put the Rowing's paper here? And
You got me there. I'm the Ettridge paper. I'm with Ettridge.
Yeah, okay,
You got me.
good,
Thank
good.
you.
Wonderful.
Always good to have another site.
Okay, and then so we look at because of the disclosure, try to hide disclosure is kind of proprietary costs for competition firms. And actually many firms opposed the 131 because due to the competition. And I think Paul's paper kind of also mentioned that. But FASB says that the 131 has already addressed concern of competitive harm by eliminating requirements to disclose R&D expense and liability by the segments. They also, FASB also argued that the current required disclosure is just kind of some common, you know, information that is not more detailed or specific than the information typically provided. So this is FASB's argument. And but manager may not think that way. So to deal with the proprietary costs, and there's quite a few studies that show that they do actually high competition firms. They do try to do different things. They reduce the number of reported items, and with a reason, and also that we found that the negative stock return respond to the passage of 131 are really subject to the competitive harms, you know, from the firms. So this study basically kind of saying that firms will do something to deal with this proprietary cost and try to hide the information, so-called legally. That and also, for example, some recent study look at the if 131 that increase or require, right, more number of reported segments, they will greater information reduction from the material contracts. So this study basically say the importance of proprietary costs for the company to make their decision. Yes, Lisa.
Hi. Also, just a comment or suggestion here, because you are talking about the literature review. I completely understand. Like, here the focus is mainly on the external capital market, the external market, external information environment, because your outcome variable is the investor reaction. But because the setting itself, SFAS 131, is related to the internal segment reporting, actually, I feel like it may also be helpful to link to the literature on the internal information frictions, because it's also likely that we touch on this, likely that because like more multiple segments for headquarters manager decision maker is actually harder for them to collect the information from the divisional managers, or like more friction, not just the information symmetry, but also uncertainty, estimation risk. So there are a lot of frictions within those big conglomerates. So I feel like for the literature review, it may be also helpful to touch on that type of literature.
Oh, okay, that's a great suggestion. Yeah, thank you.
One question from
yes.
Christina.
Yes.
Yeah, I would like I think, this is, adding to Lisa's, comments. And my comment here is that, so sorry. Yeah. My comment is that, it is possible, that in firms that experience great, large vertical integration, the allocation of assets is not very clear. So I wonder whether, you capture that. To give you an example, you could have, a company having two subsidies, okay, or two segments, and operating, out of the same premises, the same office, the same. So it would be very difficult for them to report the building because the building is the same. It's one building, one room, I don't know. And it's very
Yes.
difficult to allocate the assets, the buildings that belong to the one segment and the assets that belong to the other segment. So that is, there are, measures of, vertical integration. So
Yeah.
you could really try to see if you are capturing something like that here.
Yeah. And so I think that also will be a reason, that they don't provide the
Yes.
individual element for the segment, and then it will also be a good, if I want to say, excuse to not report, the total asset because it's difficult to allocate. I'm sure in some of the comment letter, which I'm going to look at it, they probably respond that way. And but still, that information shared by two branches, may be important. So this is saying that, my finding basically saying that, some of the missing information intentionally or difficult to get are missing, and should help the market if some additional disclosure can be provided. Yeah, thank you for the suggestion.
Yes. Thanks.
Yeah, very good. Thank you. Okay. And so I guess this is saying that why we want to do this by omission, because of so far I think in empirical study haven't really provided this, but we kind of all know more information is needed. So this is what I do, we do, that again, a quick summary. If that omission, that do not diminish, okay, because that's manager's view. Manager is more important, so we should not see any delay. And but as we have discussed, if the manager approach or their internal decisions, they are not great, okay, and so then in that I think Lisa and Christine all mentioned several cases, then we will see delay in price updates. And another thing would then be that they intentionally withhold it. Again, mostly legally appearing, they are following manager approach. And but if they use different ways that to try to not report those important information, then we probably see the delay in price updates. So this is what we are hypothesizing. Okay.
Yeah, we have a
Yes.
question from Wakar.
Hi, I just
Wakar.
had
Yeah.
a couple of points in my mind that might
Sure.
help. The first one is that just like the accruals literature, we have this expected accrual, or what is the baseline to compare against. And I think this is in line with what Ayung was also mentioning, that what is it comparable? So for example, if you have an industry where it is very segment prone, then that stable sort of expectation of number of segments would give a good benchmark to see if your reporting line items are better or worse. So I think baseline inquiry into establishing, okay, historically, this has been a high segment industry, and now we see these deviations which are causing these anomalies, would sharpen the effect that you're looking for. And the second idea or phenomenon that I had in mind was we have a lot of disaggregated disclosure now mandated from revenue standards, right, which focus on revenue very squarely. That is probably by far the most interesting disclosure to the interested parties, because you can infer costs from those revenues anyway. And many disclosures that I teach in FSA show costs and assets as part of disaggregation of revenue under revenue disclosures. So I just wanted to double check, depending on your sample set. Sorry, I haven't read the back end very carefully. So if the sample is extendable and discussion started in 2014, on the ASC 606, and then you see all those disaggregations putting up in comparatives and things. And there is a certain overlap with the segmental reporting. Even in IFRS 8 and IFRS 15, there's this little bit of a convergence. And then I think it is synonymous into the US GAAP case as well. So it might add to your inquiry.
Yeah. And so the revenue recognition, I mean, we do not specifically evaluate it. And that probably will affect our error term through time. We do have like a time analysis, see how things work. And also in terms of earnings management, that we do not analyze earnings management, but we look at the likelihood that they do earnings management like governance, poor governance. But I think we can also, add a subsample by looking at those and also control the revenue recognition principle. Yeah, that's good suggestions. Thank you. Okay, and then this is our data using compute set segment, and we also use analyst earnings forecast, and we look at the informations, from readability, 8K reports, etc. Our sample period ends at 2020. And our segments looking at business operating segments. And a segment level financial data item based on compute stat will have 25 line items, 17 are mandatory, 8 are voluntary. And so that we also exclude if items missing, it's not because they don't report, it's because the firm level doesn't even have that data. So this is our basically sample. And this is frequency of mandated item, and I can list from a different item, and on average that multi-segment firms omit a mandated item about 50%. And so some of the omission, I think it's natural, some of may need a little bit management, or I wouldn't want to call manipulation, but anyway, those are the statistic result. And another one is we look at voluntary items. Voluntary that it's kind of difficult for us to assess, but we basically look at the data to see if firms actually provide voluntary, and see some firms do not. And which is no problem if they do not provide voluntary, but we wanted to see how our results are driven by the mandatory versus voluntary based on the data. And this is how we measure that. We look at, again, use compute stat, we have 25 items. Then we count the number of line items that the firm disclosed for each segment. Then, as I mentioned before, we weigh it by segment sales. And then we look at that number, weighted average, and then relative to the total reported item, and to get kind of a sense of the relative ratio. That we also look at if they are reportable. That means if they report in the consolidated financial statements. So basically, we measure the mandatory segment line item based on the policy that of procedure I described here. And we have the total average measure, and we have measure for mandatory and voluntary. Okay. And so this is the time trend count of segment items. We can see before the ASC 280 that it was kind of flat, but with a little bit decreasing trend. And then after 280, immediately increase a lot more and then stabilize. So this is basically showing that ASC 280 indeed is a shock, like on the reporting segments. And then we also look at the correlation of the segment line items reported with a few characteristic which we showed here. And actually, I want to point out, it's kind of interesting. It's not correlate. Actually, it's not positive correlated with the firm's business complexity and the number of segments and the component line items, etc. Okay. All right. So it's our basic sample. So our main test is the stock price updates to industry news. And we follow finance paper that what they did is that they find out the prediction, the lead lag of the return. And the idea is that, for example, if a new research suggests eating chocolate can increase life expectancy, this is industry news. Investors incorporate this news easily to a single segment firm that making chocolate. But how about for the multi-segment firms? And so to comparison that the difference that it will be that response to this industry news single segment is much faster than the multi-segment. So what we follow their methodology and try to show how the lead lag work. And so they have documented multi-segment have a slow stock price response. A recent paper also showed that the lead lag relation significantly diminished post 131. So this is saying that 131 does improve the information environment with multi-segment. And different from those studies, as I mentioned already several times, we want to look at a number of disclosure or omissions of segment items to see if they actually omit more or have a stronger delay using a similar methodology. Okay, so following their methodology, we construct a we call it pseudo multi, using single segment firms operating in the real multi-Stephen industry. So we measure the period T's pseudo CTP incorporation, and based on the allocation of this different ratio for different industry, and then we figure out from the pseudo multi-segment, see if we can predict next period's return. So this is the methodology, okay, used by these two research papers. Okay.
Agnes, we have 2
Yes.
minutes left.
You're kidding me.
Time
Okay.
flies, yeah.
Good. Okay, but then anyway, you find the lead lag return relation, and we use the portfolio analysis, and we do find out the segment line items that will have less price efficiency because of the prediction is much higher. That means the delay is longer. Okay. And then we mandatory, voluntary, we find out mandatory explain more. And here is the that we use the lead lag. We also draw, through the time, and so you can see it. It happens, but then gradually flattened. Okay, and now we do the regression to confirm our analysis, and we do find out the prediction when they segment items. It's more that. And then, we do see that the prediction of futures return decreased. That means this information has already been digested, okay, prior, or early, I should say. And then we do, as I already summarized, we do the cross-sectional analysis based on managerial ability, corporate governance, proprietary cost. And this basically you can look at its high ability that we do not see, okay, that price inefficiency. And but low ability we do. And the same thing with good governance and internal and external. And we also analyze some proprietary costs based on the competition using R&D, intangible asset, etc. And we do like high competition type of firms, they actually have more price inefficiency. We do a lot of robust additional analysis. And for example, we look at firm complexity using the percentage of complexity words in 10K. And we do find out that when it's more complexity, we have a higher price inefficiency. And we several measures of complexity, I don't need to go through in detail. And we use difference that we do find out after, as my chart show, it does increase the segment disclosure, and the delay also decrease. Okay, so I think I can skip this quickly. And we look at the earnings response coefficient, and we find out more line items, higher ERC. And also, oops, sorry, let me see if we can go back. This is the PED, and you can find that the more news, you get like less drift, and compared to the less disclosure. And so let me summarize that there's we based on our finding, we feel like the mandated line items are crucial, and but the thing is like a price inefficiency exists, so that probably means that the effectiveness get reduced by, you know, like by some companies that they do not really apply the management approach efficiently, or they legally hide some news. And so that the suggestion would be the FSB's recent mandate to disclose significant segment expense is a positive step, but the success really depends on how managers, you know, really follow that, or how this disclosure is governed. So that is, I'm sorry, I guess I said 3 minutes. Okay. Thank you so much
Very
for attending. Yeah.
Thank you, Agnes. Thank you everyone for coming. And just as a reminder, for our next
Oh, I'm
session.
sorry. I should click the next one. Next. Sorry, I
It was
forgot.
very interesting. Thank you.
Thank you so much. But let me next.
Yeah.
Not net. I type it quickly. So next event will be April 1st. And please note that time changed to the 10:30 a.m. Eastern time. Okay.
Yeah.
Sorry,
Thank you.
Yang. Yeah.
Everybody.
Thank you so much.